Have you ever wondered where money comes from? Not the coins in your pocket, but the whole system. Who decides how much money is out there? Well, a big part of the answer lies with an institution we hear about all the time, but maybe don't fully understand: the central bank. Today we're going on a journey through time to uncover the fascinating and sometimes turbulent history of central banking. Our story doesn't start with fancy buildings and economists in suits. It starts with merchants, trade, and a big problem: trust. Hundreds of years ago, the financial world was a bit like the Wild West. You had countless private banks, each issuing their own banknotes. Imagine going to a market where every stall wanted a different type of currency. It was confusing, risky, and a huge headache for business. Merchants needed a reliable form of payment, and governments needed a stable way to finance their expenses, especially during wartime. This brings us to our first major milestone, the Swedish Riksbank, founded in 1668. It is the world's oldest central bank and was created to lend money to the government and act as a clearinghouse for commerce. But the blueprint for modern central banking was truly forged just a few decades later, across the North Sea. In 1694, the Bank of England was born. England was financially drained from a long war with France. A group of wealthy merchants proposed a deal. They would lend the government £1.2 million in exchange for a royal charter to establish a bank. This new bank was given the exclusive right to issue banknotes and act as the government's banker and debt manager. This was revolutionary. For the first time, a single institution had the power to manage the nation's debt and control the money supply. The Bank of England became the model that many other countries would follow. As the 18th and 19th centuries unfolded, the idea spread. France established the Banque de France under Napoleon in 1800 to stabilize the economy after the French Revolution. Other European nations followed suit, each creating their own national bank. These early central banks had two main jobs: finance the government and provide a stable currency. They weren't yet focused on things we hear about today, like fighting inflation or managing unemployment. Their primary role was to be the government's financial backbone. Now let's cross the Atlantic to the United States, where the journey was much more contentious. The founding fathers were deeply suspicious of centralized financial power. Alexander Hamilton, the first Treasury Secretary, championed the idea of a national bank to manage the new nation's debts and create a unified currency. This led to the creation of the first Bank of the United States in 1791, but its charter was only for 20 years. When it expired, political opposition, led by figures like Thomas Jefferson and Andrew Jackson, who feared it gave too much power to wealthy elites, prevented its renewal. A second Bank of the United States was chartered in 1816, but it too met a political end. For the rest of the 19th century, the U.S. operated without a central bank. This era, known as the free banking era, was marked by frequent financial panics. Without a lender of last resort, small bank failures could spiral into full-blown economic crises. It was messy. Different banks issued their own notes, and their value could fluctuate wildly. The tipping point came with the panic of 1907. A failed stock market speculation triggered a wave of bank runs across the country. The financial system was on the verge of collapse. It was only saved when a private financier, the famous J.P. Morgan, stepped in and organized a bailout, using his own capital and convincing other New York bankers to do the same. While he saved the day, the crisis made it painfully clear that the country couldn't rely on the whims of one wealthy individual to secure its entire financial system. The need for a formal public institution was undeniable. This led to the passage of the Federal Reserve Act in 1913, which created the Federal Reserve System, or the Fed. The Fed was a uniquely American invention. Instead of one central bank in the capital, it was a decentralized system with 12 regional reserve banks spread across the country, all overseen by a board of governors in Washington, D.C. This structure was a political compromise designed to balance central authority with regional interests. Its initial mandate was to provide an elastic currency, serve as a lender of last resort to prevent bank panics, and improve the supervision of the banking system. The 20th century was the true crucible for central banking. The Great Depression of the 1930s was a brutal test. Many economists, including the influential Milton Friedman, later argued that the Fed's policy mistakes, specifically allowing the money supply to collapse, turned a bad recession into a catastrophic depression. This failure led to a major re-evaluation of the role of central banks. It wasn't enough to just be a lender of last resort. They needed to actively manage the economy. After World War II, the Bretton Woods Agreement established a new international financial order. The US dollar, convertible to gold at a fixed rate, became the world's reserve currency, and central banks around the globe managed their currencies in relation to the dollar. During this period, the ideas of John Maynard Keynes dominated economic thinking. Keynesian economics suggested that governments and their central banks should actively intervene to manage economic cycles, stimulating the economy during downturns and cooling it off during booms. Central banks started using tools like interest rates to influence employment and growth. But this era came to a screeching halt in the 1970s with the stagflation crisis, a toxic mix of high inflation and high unemployment. The old Keynesian models didn't seem to work anymore. This crisis, combined with the US abandoning the gold standard in 1971, ushered in the modern era of central banking. The new consensus that emerged was that a central bank's primary, number one job should be to control inflation. The theory was that by keeping prices stable, you create a predictable environment for long-term economic growth. Central bankers like Paul Volcker at the Fed became famous for taking tough, politically unpopular measures, like raising interest rates to punishingly high levels, to break the back of inflation in the early 1980s. This period also saw a global trend towards central bank independence. The idea was to insulate central bankers from short-term political pressure. Politicians might be tempted to print money to finance spending or boost the economy right before an election, leading to long-term inflation. An independent central bank, staffed by technocrats, could focus on the long-term goal of price stability without political interference. Then came the 2008 global financial crisis. This was the biggest test for central banks since the Great Depression. As the global financial system seized up, central banks around the world sprang into action. They slashed interest rates to near zero, but that wasn't enough. They had to invent new tools on the fly. We started hearing new terms like quantitative easing, or QE, where central banks bought massive amounts of government bonds and other assets to pump liquidity directly into the financial system. They became the ultimate backstop, preventing a complete meltdown. The post-2008 world has created a new set of challenges. Central banks have become more powerful and involved in the economy than ever before. Their balance sheets have swelled to trillions of dollars. This has led to intense debates. Have they become too powerful? Are their actions creating asset bubbles or increasing inequality? And what happens when the next crisis hits and interest rates are already at zero? Today, central banks are grappling with new frontiers like digital currencies, climate change, and the economic fallout from the global pandemic. From a simple need for a reliable banker, they have evolved into the powerful, complex, and often controversial guardians of the global economy. Their history is a mirror of our own economic and political evolution, a constant struggle to balance stability, growth, power, and trust. Understanding their story is essential to understanding the world we live in today. Thanks so much for watching. If you found this journey through financial history interesting, make sure to hit that like button and subscribe for more deep dives into the systems that shape our world. See you next time.